welcome to this week's episode of Financial Freedom in Medicine. Big news. This is our 10th episode. I can't believe we've come this far. We're excited to be here. Happy to have all of our listeners here with us. Before I get started, I did hear that it might be someone's birthday today. Is that, am I correct?
So big ups for our boy.
Mickey, how old are you turning today, bro?
The big 2-4. It's getting a little too high now.
The big 2-4.
Oh, get out of here, dude. I'm 27. I don't want to hear it.
Dude, I'm turning 27 in a week. I don't know why he's talking about 24.
Well, since it's our birthday boy's birthday, Mickey, can you tell us what this podcast is about?
Yeah, of course. Well, first off, big thank you to you guys. I appreciate y'all. But this podcast is where we talk about financial literacy, specifically for a focus on those who work in the healthcare industry.
Yeah, exactly. That's exactly right. So look, we noticed the gap in the education for those specifically in medical school with regards to financial literacy. It's not a class unless you do what Mickey did and you major in business, but it's not a class that we're often exposed to studying sciences in undergrad and then in medical school. And what we wanted to do is we wanted to provide a platform that gives medical students and those in the healthcare industry access to financial literacy education. Now, even if you aren't in the medical field, but you're new to the finance world, this podcast is perfect for you. We're going to be discussing subjects that are very pertinent to your lives as well. We've also made a concerted effort to discuss information in a somewhat logical manner and start out as if you knew really nothing about finance at all. So hence, anyone new to the financial literacy world should get great value from listening to this podcast. Now that we've dived into the world of stocks, we're going to shift gears a little bit and start talking more about personal finance basics. We've heard from many of you that there are a lot of personal finance topics you'll want to learn about. So we're going to create a little mini-series, just like we did for stock investing, all about personal finance, things like retirement accounts, savings accounts, how loans work, how to create budgets, life insurance, et cetera, et cetera. If you have any more questions or there's a specific topic you want us to hit, please send us an email to financialfreedominmedicine@gmail.com. So with that, Ramiz, Mr. Coffee Sipper, why don't you start us off with today's episode on retirement accounts, Roth accounts, IRAs, and 401ks.
Yeah, Brennan, let's go. So like every episode, I really do want to start off by saying we aren't finance professionals and we encourage you and everyone to do their own research. There are a lot of resources out there that you can go gain knowledge on, and we've used them. There's Investopedia for just as an example, and you can go learn as well. But like Brennan said, you probably heard these terms. I heard it like maybe last year or so. IRAs, Roth IRAs, 401ks, everything when we were doing our financial literacy with the school financial counselor. And people say it's very important, so let's dive into it. Before we go down on this part, I want to start at a very high level. These are special trading accounts. Think of accounts that you could buy stocks and bonds with that are meant to help you save and grow your money for retirement. Specifically, I want to bold out for retirement. They have certain advantages, but also certain restrictions. Just like most accounts they would create in the finance world. Wait, let's actually put it into an analogy for healthcare listeners. It's like choosing regular insulin or a GLP-1 analog. They have advantages and disadvantages. So you must choose the one that works best for your situation. This is why we do this podcast, all right? We're here to give you the information so you can apply it to your own situation and make the best financial decision. But since our Mickey's our credential finance boy and our birthday boy, I think I'm going to let him do the dirty work on defining these terms for you guys.
Ramiz, you give me too much credit, but I'm going to try my best.
Yeah, let's go.
So let's dive in. So just like with any finance jargon that we've talked about on this podcast, there's a bunch of rich guys in New York and government officials who came up with some fancy acronyms to make themselves feel important. Once you understand that lingo, things are really easy. So we'll start off with IRAs. IRA stands for Individual Retirement Account. Pretty self-explanatory. It's an account, like Ramiz was saying, usually through a brokerage or a bank, where you can save money and trade stocks, bonds, and a few other things, and it's known as a long-term tax-advantaged savings account. The purpose of this account is to allow people like you and me with extra savings a method to sock away some money to invest it and let it grow, and have a nice little nest egg for their retirement. There are some strings attached, which we'll get into later. There are rules to follow, but it's a great way to save for retirement because it comes with some nice perks related to taxes, and that's what we want to hit on today in this episode. So basically, it's a special account that allows you to invest up to the maximum yearly contribution from your yearly income, but I, as an individual, get to open and manage that account in those trades. And so now you've heard of 401ks. They're very, very similar to IRAs with a few differences, but they're usually sponsored through your employer. So let's say you work for a big health system. Let's call it Kaiser Permanente. Kaiser Permanente will offer you a 401k. So the fancy lingo that the government came up with is a defined contribution, tax advantage retirement savings plan sponsored by your employer. So basically, it's just another form of a retirement account, but your company or your hospital that you're going to work for in the future will be the organization that's managing those accounts investment. So IRA, I manage it. The 401k, the company's managing it.
All right, Mickey. So if these are so similar, there's got to be some differences, right?
Yeah, that's a great question. And the answer is yes, there are a few key differences, and most people can invest in both. So an IRA can be used by any individual. You have to meet certain income requirements, which we'll get into later, and they can be opened through a brokerage. So Fidelity, Vanguard, Schwab, you can open them today if you wanted to. But you can usually choose the stocks investments you make with those, with the money you put in, because you get to manage it. It's an individual retirement account. We get to manage it. 401ks, like I mentioned before, are just administered through the company you work for. So when you start a new job, part of your onboarding is going to be creating your 401k and electing your investment plans. 401ks usually don't let you choose individual stocks or bonds to invest in. You have to choose between a few different investment options or portfolios. So let's say you're very risk averse. You want very safe investments. You can choose the risk averse portfolio. You can choose the long-term oriented portfolio or the aggressive growth portfolio, just to name a few. But 401ks are usually managed by fancy suits in New York. And another cool perk about 401ks is company match that IRAs don't have.
Wait, Mickey, that's a very important point, and I want to quickly chime in. It's very important to look at your contract when you get hired, because your contract usually has these specifications in fine print, right? So many employers, like Mickey said, match a certain percentage of your 401k contribution. This means your company will essentially give you extra money or match your own contribution to invest into your retirement. It's really important to consider because over time, you want to have your money growing and working for you, just like the aim of this podcast. Having that extra bit that will allow you to go compound a lot better over time. The best part about it, you don't have anything to lose. You're the winner if you play smartly from the beginning. Also, if you do get that little win from listening to this, remember the four of us when you're millionaires in the future. Don't feel too bad. And don't feel too bad about your employer. They also get really good tax benefits for funding you that way.
Yeah, that's exactly right. Please remember to send us some love when you become a nice billionaire on your yacht in the Mediterranean. We greatly appreciate it.
Yeah, send us that invite. Come on.
Yeah, absolutely. So just to hammer home what Ramiz was talking about, illustrated with an example. Let's say I'm a big fancy attending now and I make $100,000. That's just to make the numbers easier. I'm hoping I make a lot more than that when I become an attending. But the hospital I work for, let's say, offers a 5% 401k match. This means my hospital will give me up to 5% of my income in extra money into my 401k. So if I put $5,000 into my 401k, the hospital will give me an additional $5,000 if I put in to my 401k. If I put in $3,000, I will only get the additional $3K. So it's up to what I put in, up to that max amount. So for me, that was $5,000. So I should put in $5,000. And just to think about that, let's say a company matches $5,000 each year for 10 years, and that gets invested in the stock market, and you see the average 10% return over 30 years. That $5,000 every year becomes $267,000 at retirement. And that's only if you contribute for 10 years because for some reason you might move jobs or something. Let's say you work for the same company for 30 years and you contribute $5,000 a year at, let's say, 7% interest or compound interest. That number becomes $470,000. So that's why it's really important to invest just the bare minimum even. Invest at least the company match into your 401k. Otherwise, you're leaving free money on the table. But this is all assuming that you can afford to put that much into your retirement account and you don't need it for other basic necessities like rent or mortgage.
Yeah, Mickey. So, question for you. So, you talked about the 5% match. I would imagine there's different hospital systems or different companies will offer different amounts of percentage matches, right? So, maybe some companies offer 3%, whereas some offer 5%, and that's like a negotiating tool. Would you say that's correct?
Yeah, absolutely correct. So, most companies, again, it varies on the company. So, the company I worked for last year, I got 4% match. Some companies will offer 5%. Some companies are really nice and they can offer up to 7%. It just depends on the company. It's something really important to ask about when you're negotiating job offers, because maybe they might be able to bump it up, or you can use it as something to compare different job offers. If you think two are the same, but one company offers a higher match, you should go for that company because you'll make more money in the long run because of that power of compound interest. So it's a great question. IRAs don't offer these company matches because they're not administered through companies. We've hammered home about 4 times now, or through your own individual brokerage accounts. So it's just something to be mindful of.
And then, so if I was a big fancy attending like you, Mickey, when I grow up one day, because I'm not that old like you now.
Oh, he just called you old. Yikes.
I'll about to find him
No,
behind his
just kidding.
house after
I'm
this.
joking. But anyway, if I wasn't attending, right, can I have an IRA and can I have a 401k at the same time or no?
Yeah, you sure can, depending on your income level. That's the big asterisk that you have to look at the bottom of the fine print for. But you could be eligible to invest in both. So if you have the income available, you should totally utilize both because they're a great way to sock away some money for retirement, and you get the tax benefits, which we're going to talk about a little bit.
I got to be honest. I'm still pretty amazed at the power of compounding. Albert Einstein calls it the eighth wonder of the world, and I know I hammer home on that all the time, but wow. So you've given us really some great info about 401ks and IRAs. I've heard about something called 403bs, but I don't know much about them. What exactly are those?
I think Mickey's done for a little bit now. He's been yapping a little too much.
Is he so old he needs a little rest?
He's getting old now. He's got to have some breaks. So let me take this one from you, Mickey. 403bs are basically the same as 401ks, but they're for government jobs or people who work at nonprofits. So essentially the same thing. Something that the listeners who work at free nonprofit clinics could use to ensure they make contributions to their retirement funds.
Gotcha. Okay, that makes sense. Well, Akshar, since it seems like it's your turn now to start yapping away, can you explain a Roth account and what that is for our listeners?
Yeah, for sure. So I'm just going to give you the definition straight from Investopedia. A Roth IRA is a type of tax-advantaged individual retirement account to which you can contribute after-tax dollars towards your retirement. The primary benefit of a Roth IRA is that your contributions and the earnings on those contributions can grow tax-free, bold, and be withdrawn tax-free, bold again, after age 59 and a half, assuming the account has been open for at least 5 years. In other words, you pay taxes on all the money going into your Roth IRA, and then all the withdrawals you will take out after age 59 and a half are tax-free. Huge.
Yeah, interesting. So I think Akshar's been yapping a little too much now. But Brennan, you've been awfully quiet over there today. Why don't you explain the difference and benefits of those different accounts and the Roth accounts for our listeners?
For sure. I feel like there's a bit of beef between Akshar and Mickey right now. MB, you and I are going to stay out of that one. But
listen, Brennan, we're too old for these little
for those
young
shenanigans.
Old guys.
Yeah, we're the two oldest ones on this podcast. So you talking about being 24 and an old man is a bit ridiculous. But I'll go ahead. So the big benefit of these accounts is that really it can help you grow your money in ways that typical savings accounts would not. So the government has actually done something useful here. We'll leave that as it is, and provided a way for citizens to save money for retirement with certain tax shields. So I think the easiest, honestly, way to explain it is the difference between Roths and a normal IRA. So the big difference in these two accounts is at what point the money you are putting in or taking out is taxed. So in a normal IRA, the money is not taxed until you take it out. So you put money in, from your income, and then eventually when you go to take it out in retirement, that money is taxed. With a Roth, the money is actually taxed before you put the money into the account. But then on withdrawal, there's no taxation.
So for our listeners, Brennan, when might be a reason to choose either of these accounts, depending on a person's finances?
Yes, that's a bit of a lecture, but I'm going to do my best. So it depends on your current tax bracket and what you think that tax bracket might be when you retire. So if you're a medical student and you're going to be a resident for a while making bare minimum amounts of money, and when you retire, you think you're going to be an attending physician with some income properties and other streams of income, it would make sense to open a Roth now because your tax bracket right now is most likely less than it's going to be down the road, right? So I would rather be taxed on the money I'm putting in now at a very low tax bracket than when I take it out down the road. So really, if you're young, you've yet to reach your peak earning years, you're going to want to go with a Roth. The same goes for the opposite, where a traditional IRA might make more sense if you believe your tax bracket will be a lot lower when you retire versus now. So let's say you're listening to this and you are a new attending physician who is making lots of money. It may make more sense to open a standard IRA. Another difference between traditional and Roth IRAs lies in how you withdraw money. So with traditional IRAs, you actually have to take a required minimum distributions, which are mandatory. And they're mandatory taxable withdrawals of a percentage of your funds, even if you don't need the money. These have to start by the age of 75. With Roths, this is not the case, which means if you never need the money, you can keep it there and use it as a wealth transfer to vehicle for your children. Now, one thing I would say is these rules change often, especially with presidents. These rules can tend to change. So don't listen to this down the road from now and think that this is the exact case. Make sure to do your research. But as of right now, those, I believe, are the rules. Another benefit of both Roth IRAs and traditional IRAs is the ability to choose your investments. That's what Mickey was talking about earlier. Often people want to have control over what they invest in, right? In a 401k, you're really limited as to the options that your company gives you. You can invest in different types of accounts, but you can't truly choose what you as an individual want to invest in. It gets a little confusing as to what exactly you can do in your traditional IRAs accounts. So, seek outside counsel. But Investopedia mentions that Roth self-directed IRAs allows you to invest in a multitude of assets. So it's not just stocks that you can invest in. You can invest in stocks, bonds, money market funds, mutual funds. You can hold assets that aren't typically part of a retirement portfolio, such as gold, investment, real estate, partnerships, and tax liens, even a franchise business. And then the last thing that I wanted to discuss was certain tax benefits with Roth IRAs and traditional IRAs. So with your traditional IRA, you're not taxed on the money that you put in. And what also is nice is when you do put that money away, that is tax deductible income. So you're not going to be taxed on that income for that year that you have put away into that traditional IRA. However, if you put $5,000 in and somehow that $5,000 becomes $1 million in a traditional IRA, you are going to be taxed on that. Whereas with a Roth, again, you're taxed when you take that money and you put that in. But if that $5,000 of taxed money becomes $1 million, you are not taxed on that $1 million. Does that make sense? Fantastic.
Yeah, so Brendan, we're making it sound really like a cheat code here, but it can't be all rainbows and butterflies, right? Are there any drawbacks to these things?
MD, you got that, bro. My voice is tired.
Yeah, I'm gonna I'll let the other old guy take it, right? But there are some downsides on using these accounts, and knowing these downsides can help you make a more informed decision. Just something I harped on about at the beginning of every podcast. Research, right? All these accounts are made with pros and cons, and they're tailor-made for your own retirement fund and your own situation. So you want to learn about these situations so they can apply the best they can in your own personal life. If you are working for a hospital system, private clinic, your own clinic, or a nonprofit free clinic, all these different types of accounts can help you save a lot more just dependent on your situation. So listen up. Let's talk about some negatives, all right? When it comes to 401ks and IRA funds, there are several important rules and restrictions that you have to keep in mind. These accounts are designed to help you save for retirement. So accessing funds early can result in penalties. Withdrawing money before the age of 59 and a half, I think 2024 rules, typically incurs a 10% earlier withdrawal penalty. And for non-Roth accounts, you'll also owe income tax on the amount withdrawn. So once you reach 59 and a half and withdraw funds without penalties, and you're at the age of 72, you've been chilling, and you say, I don't want to take anything out, the government actually requires you to start taking minimum distributions from traditional accounts, and you get charged money if you don't take money from it, which is pretty funny. But that's the difference that comes in with the Roth IRA. Our Senator William Roth came up with the idea of IRA Plus, which basically differs from the non-Roth IRA by collecting tax on the contributions during the time of investment, just like Brennan said. So IRS does not collect it later. The downfall on that is pretty straightforward. Your taxes get taken away right there, so you don't have that extra fund to deduct on your actual income. But like I said, it all depends on your own situation, what works for you, what doesn't, and learning about these rules, pros and cons, can work in your favor if you know about them.
For sure. No, that makes sense. So
yeah,
when we do start, making some money, for our listeners, is there a minimum/maximum amount that we can put into these accounts? I mean, could I just put my whole paycheck into this account and live at the hospital?
Yeah, so I can jump in.
Rent?
I wish. The government knows that this is a good old way for people to invest. Just good old Uncle Sam can't let people get too rich now. Can't be taking too much advantage.
Can you imagine? The government knows Brennan exists, so they have to make rules accordingly.
I know. I know. So another downside of these accounts is that there are indeed maximum yearly contribution limits. So you can't just invest unlimited amounts of money in your 401k and IRA. There is a limit to which you can invest. Unfortunately, maybe Brennan won't be getting that yacht in the Mediterranean. But for example, in 2024, individuals can only contribute up to $7,000 into the IRA, $8,000 if you're over 50. For 401ks, that limit is $23,000, $30,500 if you're over 50 years old. So let's say you invest in both each year, you max them out. You can only invest up to $30,000, assuming you're less than 50. That's a lot of money you can invest to max out these retirement accounts each year. But because of the tax benefits of these accounts, it would be nice if we could invest more than the maximum if you had the disposable income to do so. So that is the one downside. But it's really not that bad of one because $30,000 is a decent amount of money to sock away each year if you're able to. There is also one more downside I wanted to throw in there. There are income level restrictions on the use of IRAs. So for IRAs, in particular Roth IRAs, since they're not administered through your employer and they also have those great tax benefits, you have to have income below a certain amount to be eligible to use a Roth IRA. So if you file taxes as a single person, your modified adjusted gross income, so a fancy way of saying the income you made after some adjustments to your taxes, must be under $161,000 for the tax year of 2024 to contribute to a Roth IRA. So if you're married and filing jointly, that number becomes $240,000. So 401ks and Roth 401ks don't have the same income restrictions, but Roth IRAs do. So that's something to be mindful of. Most physicians will be hopefully
say that one more time. I think you said 401ks and what?
Roth 401k. So we talked about IRAs and Roth IRAs, but 401ks also have a Roth component too. So that's also something to be looking at when you're looking at job offers to see if your company offers a Roth 401k, because you could have a Roth IRA and a Roth 401k and pay no tax on those millions of dollars you're going to make in the stock market when you retire. It's all mine. Uncle Sam can't take any more from me, and I can buy that yacht in the Mediterranean. So big brain hacks.
Yeah, Mickey, you have to invite us. You have to invite us.
Oh, of course. Absolutely. Absolutely.
So Mickey, just to confirm here, so you said that you can invest up to $7,000 into your IRA per year, or $8,000 if you're 50. But if you have both an IRA and a 401k, the max you said you can invest is $30,000. Is that correct?
Yep, that's exactly right. This is something to be mindful of with these income restrictions, is that most physicians will be making a good living when they become an attending. This means they may not be eligible for that Roth IRA, but while you're medical school like us or a resident, you will be eligible to invest in a Roth IRA. So it's important to budget for possible contributions to your Roth IRA while you have the time and you can afford to sock away that money, even if it's a little bit for retirement, while you have access to that Roth IRA for investing. So because remember, what's our biggest commodity as students and residents?
Time.
Yeah, that's time.
And then Mickey,
all of us got the answer to that. That's amazing.
It's impressive. Yeah. But Mickey, just to include all of the other healthcare professionals listening, right? If you're a nursing student or you're a scrub tech or you are a PA, right? You all have to go to school for that as well. So this does not obviously just apply to residents and medical students. This applies to all healthcare professionals. And there's going to be schooling that everyone has to go through to be able to qualify to, participate in these types of jobs. So I think that could be really important as well.
Yeah, no, absolutely. 100%. So that's a good point. And one last drawback of these accounts, and then I'll stop yapping because I know Akshar gets a little mad when I do. So there are a thing called company vesting for contributions. Sure, please don't hurt me. Don't hurt me. But you got to be mindful of company vesting for contribution. So you may need to work for a certain amount of time before you're eligible to receive that company match you put into your account. So for example, let's say your employer will start giving you company matches your first day of work if you start contributing to your 401k. That money will get invested and grow in a separate account. However, that money won't be yours, the money match and that growth from that match, until you meet vesting criteria. So let's say 2 or 3 or 5 years of employment. So you have to work for, let's say, 2 or 3 years with that employer before that account becomes your account. So that money that you match gets put into an account, it gets invested and grows. But once you hit that vesting schedule, let's say 3 years, then that money gets transferred to your account. So it's something to be mindful of when you're looking at job offers.
Are you done?
Yeah, I'm done.
All right, Mickey. I'm gonna let it slide since it's your birthday. But anyways, and I have to look up to you since you're my elder and all that. But I wanted to jump in and add one quick note about 401ks. Since 401ks are through your employer, if you switch jobs, the money that you had in the 401k from the original job will still be managed by the original employer. You can elect to transfer your funds over to a new employer's 401k plan, but you got to read the fine print really well to avoid a big tax bill and ensure things are proper before you transfer that money. Or you can just leave that money to be managed by your former employer. At the end of the day, it's still your money. It's not going anywhere. The employer is just managing it for you. So the only thing on you is to keep track of the money and manage the tax implications if you're going to transfer it. So make sure you do your homework when you're switching jobs.
Akshar, honestly, I'm glad you mentioned that because I worked for an EMT company before medical school, and I believe I had a 401k, so I probably should check on that.
So that's a lot of good info on these accounts, and I actually wanted to get into a little more depth of it as well. But for people who might have an IRA, what are some strategies that they could use when investing the money in those accounts, Mickey?
Yeah, so an IRA, like we mentioned before, we get to choose the investments. So there's a lot of different ways you can invest that money once you put it into an IRA or a Roth IRA. 401ks, like we mentioned, a little more limited because you have to choose from a selection of investments. So they're company-sponsored managed portfolios or strategies. So you can select the aggressive portfolio or the medium risk portfolio, and it's a pre-selected recipe of different ETFs and stocks and bonds on the type of selection you make. But for IRAs, since we're the masters of our own world, we get to choose. So there are a few strategies. You can choose individual stocks, buy and hold stocks. You can use ETFs and use a forget strategy, just buy the ETF and forget about it, or you can mix different strategies. So I'll talk a little bit about each. So individual stocks, like we talked about in previous episodes about how we can pick individual stocks. This takes a lot of time and research to ensure you're choosing the companies you believe are set up for long-term success and growth. This would be
Do your
to buy
research.
something. That's right. Amen. So you can do your research, buy and hold for individual stocks because you're aiming for long-term growth. Alternatively, you could do more short-term trades where you purchase shares, sell them when you see short-term movements, such as sales and earnings being really good, new product announcements, and then you can capitalize on that. So another popular strategy, which I personally use for my retirement account, is just to buy a bunch of ETFs, namely like the S&P 500, the NASDAQ 100, or the Vanguard Total Stock Market Index, and just forget about it. So every year, I use my entire investment allocation towards those ETFs, and then essentially just hold these forever until retirement. So this is really popular because the market historically has returned 8 to 10% on average per year. So it's kind of a surefire way to grow your money over time. And you don't have to really worry about it because you're just choosing ETFs and then forgetting about it and letting it grow. So there's not a lot of work on your end. You're not really limited to these strategies. You can mix and match, or you can create your own new one based on your needs and preferences. But the biggest thing is to start early. Start now. Because the more time you invest, the more it grows. And that's Brennan's favorite bingo word.
Compounding.
We'll work on the timing. We'll work on the timing. Even if you are a med student or a resident with not a lot of extra money, you can still open an IRA or Roth IRA right now and start investing for retirement, even if it's a small amount, even a few $100 if you can spare it. The amount doesn't really matter too much as long as you're investing it and letting time do its thing and take you to the stars.
Yeah, love to hear that. Just to reiterate, time truly is our biggest commodity, so it's important to use that wisely. But we've talked a lot about IRAs at this point, 401ks, even 403bs, which were our government jobs, but there are other types of tax advantaged or retirement related savings accounts. Akshar, can you discuss a little bit more about those with us?
Yeah, for sure. There's solo 401ks, SEPs, simple IRAs, and company pensions, just to name a few, and we'll break all those down. Solo 401ks are retirement accounts, basically just 401ks for business owners and their partners. Same rules of operating, all that. SEPs are simplified employee pensions that are retirement accounts that the self-employed or business owners can use to offer themselves and their employees retirement savings. And then simple IRAs are retirement accounts, again, offered by small businesses this time to their employees and the owners themselves. And then these plans require employer contributions of up to 3% of an employee's salary towards their employee savings account. On top of that, the employee can still contribute to this account to save even more. The downside is that you can't take a loan from this account to yourself if you ever needed it.
So Akshar, so this is an IRA account where you can invest your own money, but you can have a company match that puts money into that account?
Yeah, so basically these simple IRAs are offered by smaller businesses that can't afford to have these bigger companies doing it for them.
Yeah.
And it's a way for them to offer their employees and themselves retirement plans.
Wow. So that seems maybe like something you could do if you owned your own practice at some point.
Exactly. Yeah. I was going to say that if you're doing some kind of private practice and you need to start offering these benefits to make yourself more attractive as a place to work, these are good things to look at.
Okay.
And then solo 401ks are another similar option again for retirement for business owners. Depending on the account type, you can contribute pre-tax or after-tax money. But again, these are all very important things that you should look into if you're ever in the space of private practice or even just owning a small business yourself. It doesn't even have to be a small practice or anything. And then one last one I'll add on is a pension plan. These aren't really used too much nowadays. I know back in the day, big hospital systems and just every big company that's blue collar you can think of, it's an employee benefit that commits the employer to making regular contributions to a pool of money set aside to fund payments to eligible employees after they retire. So it's like one big pot everyone's paying into while they work. And then once you retire, this pot will then start paying you out in terms of how long you work there, the more you're going to get out.
The military has a lot of those, like pension funds, right?
Yeah. Military is big for pension funds.
Okay. That makes sense.
But yeah, and then there's also, I think there's one more type of account. Not having it here. Do you know what it is, Brennan?
Yeah, I'll jump in. So I think you're talking about a health savings account.
Yeah.
Yeah. So these to me are honestly a little bit more confusing, but honestly, they can have powerful effects at increasing wealth and managing medical expenses. So a health savings account, if you're cool, you call it an HSA account. I did quite a bit of research on this and I'm excited to talk about it. So a health savings account is a savings account that allows you to make pre-tax contributions to pay for qualifying medical expenses. So to quiz my fellow co-hosts, so far, what is this account more similar to? Would it be more similar to a Roth IRA or an IRA/401k? If you can contribute pre-tax to your health savings account.
The regular IRA.
Yeah.
401k.
Yeah, right, exactly, because it's pre-tax income. But here's where things change. The health savings account can be opened when you have an HDHP or a high deductible health plan. So the next logical step is explaining what the heck an HDHP is. So let's dive one layer deeper and explain that. So a high deductible health plan, a deductible is the amount of money that you're responsible for paying toward an insured loss. So like when a disaster strikes your home or you have a car accident, right, the deductible is subtracted or deducted from what your insurance pays toward a claim. So a high deductible health plan is one where you're going to have to pay more over the course of the year in medical expenses before your insurance company is going to start helping you pay for those medical expenses. And that would be your deductible, is the amount you have to pay before your health insurance company starts paying for you. So the health savings account is built in to help you pay for those qualifying medical expenses to help cover that high deductible, which I think is kind of great. Now, there is a nice advantage to these plans. Your premium, or the amount that you pay monthly to the insurance company for coverage, is going to be a lot lower. Right? If they know they're only going to have to pay you for medical expenses, if the bill gets very high, they know it's less risky for them, i.e. their chance of paying or having to pay for your expenses is lower, and they're going to be willing to offer you a lower premium. It makes sense. If they know that they're not going to have to pay for your health insurance costs until after $5,000 for the year, they're going to be willing to do that for less money because there's not as high of a chance that they're going to have to pay for those expenses. So if we look at the IRS website where they discuss these high deductible health plans, we can see the minimum and maximum annual deductibles for individuals and families that would qualify as an HDHP. The minimum annual deductible, if you're a self-coverage, is about $1,600. If it's family coverage, it's $3,200. The maximum annual deductible and other out-of-pocket expenses is going to be around $8,000 for self-only coverage and $16,000 for family coverage. So essentially what that means is that you're going to be able to contribute to these accounts if you have a deductible that's over $1,600 if you're self-coverage only. As we talked about above, the money is pre-tax income. So this HSA account is an account where you can have money pulled out of your paychecks automatically, similarly to a 401k, and then that lowers your taxable income. So now you're not going to be taxed on as much money. There are also employers that will actually match your HSA contributions similarly to that of a 401k. So when you go to use this money for qualifying medical expenses, you can also pull it out tax-free. So now you've been able to put it in pre-tax, but also take it out pre-tax. This is something you can't do with a Roth or an IRA account, which is why I believe this is very powerful. Something I continue to talk about is these qualifying medical expenses. I mean, typically the government is going to set very strict rules on what you can actually use this for. What are these things? So I found a site from a YouTuber account named Debt Free Millennials. The site's called Inspira Financial. Inspira is INSPIRA financial.com, which used to be called Payflex. And on Inspira Financial, you can actually see what an HSA account will cover. And to be honest with y'all, I was pretty shocked. Boys, I'm going to spit out a few random items and you're going to tell me if you think they would be covered. You ready? Bus rides to your health appointments, covered
Definitely
or not?
not. No way.
Covered?
Those are
What?
covered. Yes.
What?
What about contacts for
Covered.
seeing?
Probably
Probably
covered.
covered, yeah.
Yep. Covered. What about like a La Roche-Posay sunscreen?
That's some fancy stuff. Ain't no way that's
I
covered.
could argue it's probably covered.
Yeah, I don't think that's covered.
What?
It's covered.
It's covered.
What about a massage gun or like an Aura health
Okay,
ring?
this is getting too crazy. No way that's covered.
Based on Inspire, it says it's covered. And then lastly, what do you think about condoms? You think those are covered?
Okay, those gotta be.
Birth
If,
control?
if health rings and massage guns are,
Probably.
condoms definitely gotta be.
Yeah,
Yes.
should be covered at that
Yes,
point.
based on inspirefinancial.com, all of those things can be
Wow.
covered under your HSA account, which I find pretty shocking because I use contacts all the time. So I would love to be able to pay for those with pre-tax income versus paying typically. So surprisingly, yes, you can get things from acne creams to allergy medicines to contacts. They even have a site called hsastore.com where you can shop for items that are all eligible for an HSA account. So you can go on and shop for things like I talked about, the SPF sunscreen from La Roche-Posay, the Aura ring, massage guns. Now, not to get too crazy, this account should be used for necessary medical expenses, but know that it covers a lot more than you might expect. So go check out those websites. So to really bring this home, what type of person should have this account? If you have a chronic illness and you're going to be visiting the doctor often, it might not make as much sense to have this type of account, right? Because you having this high deductible, most likely you're going to be going in and using all of these HSA funds up. Where this becomes super powerful is when you don't have to use this and you can let this grow and invest over time for expenses down the road. So if you're healthy, you don't see yourself visiting the doctor often, this type of plan makes a lot of sense. Now, there are maximum contributions you can make, just as Mickey said. Uncle Sam doesn't want us getting too wealthy. You guys, I'm not going to get into that just for the sake of time, but you can go onto the IRS website and you can look at all of those things. But boys, I mean, any thoughts on this HSA account or anything that I missed?
I think you hit the nail on the head. They're a really powerful way to suck away some extra money, especially for healthcare, especially when we get old. Things are going to get expensive. So it's nice to have a nice little nest egg that we can pull out tax-free that's been growing, hopefully millions of dollars that we can use for all that stuff. So
For sure. Yeah, I agree.
And yeah, like everything we say, investing, long-term, compounding, all of that is so you have that extra fund in case you need it or you just want to grow the money that you're earning day to day. So having these accounts for something like that, they'll prove beneficial eventually. Hopefully
sure.
not.
And
hopefully you don't have a health problem, but
yeah.
if you do, life is tough.
No, I agree. And MD, honestly, you make a great point. It would be a lot of fun to go on and shop and buy all these massage guns and this nice sunscreen. But if you don't let that money sit untouched for as long as you can, you're going to have a much harder time growing it. So I think that while it's tempting to go ahead and put this money in and then take it out and go shopping, ideally only use it for truly necessary medical expenses.
Yep, exactly right. Exactly right. So we know we've dumped a lot of information on y'all today, but it's also very high yield. We did want to mention a few more resources you guys can look at for more information to do your own research, just like Ramit says every episode. Just to bring it home, we even use some resources.
Wait a second. Did Mickey really say high yield?
Yeah.
Like this is
He
hitting
did
my
bring
ass.
that out.
Sorry.
so did.
The inner Anki Gunner in me is coming out. I'm sorry. But I did want us to mention some of the resources we used even for writing today's episode. So Akshar, please take it away.
For sure. So we use a lot of these great websites that we are constantly using, and you guys should go and read these because this is where we get our info from when we don't know things, and we are giving it to you. But better than that, how about you fact check us and you go check it yourself too. So some great websites we use are Investopedia, NerdWallet, Fidelity, the IRS website. Yeah, I know it seems ironic, but they have good stuff, trust. And investor.gov. And then another great resource would be people who have gone through this before, be that parents, friends, colleagues, attendings, other residents you might know. They have real world experience with this stuff, and they can offer you clever tips and advice that might be suited to your own personal situations.
Exactly. As we come to a close, I do want to mention that a lot of the stuff that we talked about is nuance, especially related to things such as taxes and investment options, things that we simply can't cover in these episodes. And in addition to that, these rules change often. So make sure that if you don't listen to this very soon after we post this, make sure you're doing research to make sure that these things are still true. So that's why we strongly encourage you to do your own research, consult a tax or investment professional before making any major decisions with your money. We hope this podcast helps educate you on these topics so you can make informed decisions, you can ask informed questions, and truly grow your money as best as possible. That is our goal, is to provide you guys with the tools to become financially literate and then also financially independent so that you're not relying on your medical jobs to provide you enough income. You're doing your medical jobs to serve others, and that you have income on the side that you can use for expenses. So with that, it's a wrap for today's episode. We'll see you on the next one. Study hard and God bless, y'all. Cha-ching.
Cha-ching, cha-ching.
Cha-ching.